Hello, Warriors. Hope everyone did okay with the Fed. Basically, as expected, and everything rallied. Everything rallied back. The dollar weakened afterwards, gave the market a lift, even NASDAQ. Let's take a look around. We have a great guest today, David Hunter. He's gotten a lot of buzz on Twitter. Everyone doing okay? Ren, how are you? Alexander, Hugo. Hello, Arena. Marco, good morning to you. Didier, Sinatra, all you Mavericks. Okay, so can you see that Euro is up? Hello, Juan. Euro's up only 2 pips compared to 21 in cable. So I took a shot last night at 48. And, you look at this 1, 2, 3. So let's see. Also, I had this 78.6 number here at 121.34 ish. Okay. And it stopped there, pulled back, went above it, and now we're back underneath it. So we'll see if the dollar could muster some upside. To me, it looks like, you have a 3 drive. It was pretty deep, but you still could count them out, right? 1, 2, 3. Okay. So you may not want to buy the dollar. I don't know if I would short it here. Because now if we get a rally back to 91.40 and above it, this moving average, 240 looks viable. Okay, so the gold came back, amazing, really hit the breakout level or very close to it here, got down to 62.76 and started to look like it was going to make a move to new highs, and it still could. But silver is acting great comparatively, and silver looks like it could still take out this high. So we'll see. Something that did surprise me was energy strength. Blake's got a nice pip on that he's making some money on right here. And, looks to me to be diverging. But, yesterday I did think that maybe when it did this, that it was just a stop hunt. But I don't know who else is short. I guess position traders might have stops over the high of the move. And this could be, maybe 78.6 back. I didn't do the fibs on it, but I have a hard time wanting to buy it. S&Ps, although they're making new highs, we had a guest on talking about 42.20 to complete. We're only about 7 handles away from that. And something interesting in Aussie, and it's only up 9 now. Check out this, I believe, really could have been just a stop hunt. Okay, it was this move right here. See this candle? So you had a little double top. High here was 78, 78, 15, 8, 78, 15, 2. So do you think there were some stops over here or over here? And then they got picked off and came right back down, and maybe this is a failing rally in Aussie. So bottom picking the dollar. Hi, DJ. Juan Fernandez, how are you? We have a great guest, David Hunter. He must have a great following because a lot of people tweeting his first appearance here on Face at the bottom of the hour. Looking forward to talking to him. Always great to have new guests and, maybe build a rotation. And let's see, was there anything else I really wanted to cover? Pound, even the pound, which is leading euro, stronger than euro. Until we take out this high, there still is a possibility that this is a failing rally. We'll see. I think the chart of the day showed a symmetrical triangle that Blake put out there, and it's on the verge of a breakout. I don't know if this was a breakout or we haven't done it yet. Blake will update us on that in a minute. I really want to, show you guys that you could really benefit by having our team work for you. So, the great charts that we get, and, you also get the E Elliott wave on it. So, here's what Greg is looking for in Euro. He's looking for about 22.5 right here. This was a 4 and a big 5. He could be right. That would be new lows in the dollar index. We'll see what happens if that's the case. But the point is, you get so many different looks, and you get harmonic looks. That was waves. This is harmonics. Okay, so actually, Andre's got a completion of a pattern here, harmonic pattern here, 21.27. So it took it out by about 20 so far. So, that to me is noise. I don't think it negates it. And you could see the 3 on Andre's charts here as well. So, invest in your own trading career. And I think a great investment for your trading career is to become part of our community and have all the research on the site, and then join all the guys in the chat room, have access to all the members only webinars, have the app on your phone so you don't have to stick around your house if you have things to do. You have many eyeballs on the market that are going to let you know for breaking key support or resistance levels, so you could act even when you're out for lunch. And the end of the week is a good time to join, because it'll give you the weekend to familiarize yourself with the website. So I think it's the best team on the net. Face is the tip of the iceberg, just to give you guys, so you get to know us a little bit and our thinking and our methods. But really, the true value is not just an intro free webinar with us sharing a few looks and talking for half an hour. It's immersing yourself in the community for many hours a day. And with that being said, bring Blake in and see what his thoughts are post-Fed. And basically, Blake, same as it ever was.
I think I mean,
MTV song.
Look, we said he was going to be dovish. He was dovish.
Yeah.
We said we shouldn't expect anything more than that. That's what banks were, most of the banks were expecting. Actually, I think every bank was expecting that. That he was just going to be dovish and status quo, and that's what we really got. And the dollar got punished. The dollar got absolutely raked over the coals as a result. And I was actually more surprised at the dollar's reaction than anything, just because I was like, wow, it really didn't blow the doors off of anybody's expectations. But the dollar just really got aggressively sold following. And then I guess on top of that, you have to look at where we were at. Let me go ahead and take over the screen here. Okay.
Nice long WTI pip, Blake.
Oh, thanks. Well, you know what?
You hardly ever trade that.
I'm sorry?
You hardly ever trade that.
No, I don't. But it's a setup. And so it's a breakout. So you have to, go.
Yeah, you cover up the title with your hand.
Why were you surprised, Blake?
What's that, Steve?
Why were you surprised about the dollar's reaction?
Because it was pretty aggressive. Although the euro, so the euro broke above this, trend line, which, you know, we knew the 121 level was big, 121.20 level was big, but no, it was the outsized moved in the dollar Canadian through the lows. The US dollar Norwegian krona continued lower. But these are big breakdowns, and Steve, I gotta hand it to you. You've been spot on with these, so great calls.
Yeah, I just thought that the only reason the existing trends stalled were the fact that the market was bracing for the Fed, and there's always a little bit of a worry, like can they surprise? Because if they surprise, obviously, you don't want to be invested, fully invested in the opposite side. But I think once the market saw that there is no surprise, it was finally free to continue where it was going. So people that had probably pared back some of their positions were like, oh, okay, we can go back in piling up on those same positions again.
Right. And so yesterday ahead of the FOMC, we were right here. Basically, we were right up against resistance, and we were knocking our head up against this 91.10 level. Matter of fact, if you look at the bias chart from yesterday, the resistance in the dollar index was 91.40, and that's like okay, we have to get above this previous support, current resistance. That's where we really need to go to turn bullish. And as soon as the FOMC decision came out, I mean, we just rolled over. And so as long as we stay in this, channel, we have to just remain bearish. But yeah, Steve, I have to say you've been spot on with that. Now, one of the other things that, and just so you guys all know, Steve he's been here preaching every day that, equity markets are strong. There's no reason to buck the trend here. They continue to go higher. But one of the things that Steve has said over the last, I want to say last week or two, maybe, if my memory is serving me correctly, Steve, you're actually now starting to think that we're going to get an accelerated blow off top soon.
Yeah, I think we might actually.
Yeah. I mean, look, I look at a lot of, everything has developed, and it's one of those events that, guys, you may think you've been in a blow off top or what's
parabolic?
Yeah, like a just a total.
I'm a mind reader.
I'm sorry.
I'm a mind reader.
Yeah, no, I'm sorry because it's so early in the morning. But if you guys have really thought you've been in some sort of like blow off top situation, I can't remember one that I've seen, at least, other than crude oil. Actually, crude oil is one that we could say was a that was it. That was definitely it, right? If you were watching crude oil when that happened, but that would probably be the last time we saw. And prior to that, I can't even remember another time that was quite that aggressive. But these are the types of moves that are the big reversal moves, the big V bottoms. And we haven't seen like a blow off top or a complete, shakeout of the market in a while. And I haven't really seen one other than crude oil in quite some time. And so to see the equity markets actually give us some sort of blow off top, I mean, we've got all the right ingredients, but I've been thinking that for a long time. But the one thing I have to say is, well, first of all, I hope Steve is right, because, having some sort of mania blow off top reversal, massive liquidation of positions, it usually marks the high or the low. And then from there you get two-way action. And that's something that I've constantly hoped for, just because we've been in a one-way grind for so long. So Steve, why do you think that the S&P might be ready this time around, where, we've kind of like toyed around with the idea, that it might be, but why do you feel that way right now?
I just see something I've seen in the past. Of course, there is there is absolutely like no guarantee that something like that is happening. But I see
Yeah.
several of the signs you see in these cases, meaning the bears are being killed on a almost daily basis. Every hint of a reversal is being that people act upon is being punished immediately. So these are the hallmarks of what usually ends up with a capitulation, even of the most fanatic bears. They're like, F it, I can't handle this anymore. I mean, I have to be long this market. I've been losing money being short this market. This market will never reverse. If I want to make money, I have to be long. And then there is no bear left. And when there is no bear left, then there is only one way the market can go. It will first go parabolic higher as bears, the remaining bears just, exit the windows and the doors. And then when there's nobody left, there is nobody that can help you anymore push it higher. So inevitably it has to go lower afterwards. But, that last stage, usually manifests in some kind of a parabolic move higher. Of course, it's going to be ideal if this gets also triggered by something that will have some type of fundamental basis. For example, some type of a progress in what the market would perceive like amazing news, like infrastructure spending or something equivalent. So that's what I've started feeling.
Yeah, and,
That
and
we
the
might get that.
thing, and like I said, and just so everybody knows this, especially those of you that are fairly new, or maybe you've been listening in just for the last couple of months. Steve has been a bull for a long time. I mean, I recall over the last following the I remember even I remember you being bullish near the bottom of this 20.
Yeah, I actually
400.
bought and held for like 300-400 handles, and then stupidly I expected, that we're going to have some type of another leg lower before we can find the bottom. So I didn't want to hold for much longer, or at least a correction, but that never happened. So
Yeah, and Steve has been very much a bull through this entire move, and so
yeah,
take
but
note of
not
what
for
he
the
has to
good,
say.
not for the right reasons. Meaning, I'm bullish the stock market not because I believe the economy is good and well, because I believe that the stock market is the arena in which the governments and the Fed fight to keep the um, um, charade that things are okay, to keep the
Right.
pretense that everything is okay.
Right. And that's well, yeah, that's it. It's because it's a liquidity move, and it's a move
Yes.
from the Fed and monetary and fiscal policy now. So speaking of which, talking about where with this move in equities, I was just discussing with one of the guys in the chat room. And by the way, if you're not a Forex Analytics subscriber, I just want to show you, this is where, we're chatting about everything from whatever to whatever well, it's all just markets related. But you can see this is all the chatting since I got up this morning. It would be right around here, and which was only an hour ago. So right around here, I got up and I said, good morning, everyone. And this is all the chatting that's happened since then in the last hour, right? So if you want to know where, myself and many traders are at when we're not on this webinar, we're in that chat room. It's a community that we've had. Some people have been chatting with me on that chat room for, not in this particular one, but they came from our previous, when I was over at Ally Financial and Trade King and Wise Trade. They've been, we've been chatting for like 10, 15 years. Rick and I have been chatting for 15 years in chat rooms. So, and we've met in Dallas. So, a lot of people go way back. But the one thing that we were just talking about, Michael, who's also been chatting with me for probably at least 10 years, Michael might be listening in right now. He's like, we were talking about Myth the Blake, right? So look at this is the dollar Canadian thought, and this is a perfect example of, you know, false breakdown, looking for a breakout above 126.50, never materialized. Now we're hitting new lows. Matter of fact, we're around these trendline lows, but Michael was saying, hey, Blake, how about this big double top in the dollar Canadian? And I'm like, man, that's a big double top. There's a lot of support down here. And that support is going to be from here, the 119 level, to here, which is the 120.50 roughly. Okay. Now, in the event that the dollar Canadian breaks down like this, okay, it should point somewhere towards the 93-cent level. Now, for those of you that were not trading currencies back in 2007, 2008, I was on a webinar on the Morning Edge webinar back in 2007. And some of you listening in here right now remember me coming on air. I was on my way out of town, and that's when WiseTrade actually we had a studio. We had producers, like physical cameramen and women, and we had a whole production team and hosts and whatnot. And I came on set and I said, hey, last night, because I was awake all night watching this, last night we had a complete, capitulation of the dollar Canadian. And I said, I don't think we're going to see that level ever again. And that was the bottom. And then the next day, and I went long because I was actually traveling, and I went long, and I only captured, from this 93-cent level towards 102. I think it was 1,000 pips, but I did not expect, obviously, that to happen. This is post financial crisis, or this is the GFC, right? But I never thought we would reach those levels again, and I still don't. And here's why I point all this out, because we are approaching really key support, and double tops of this magnitude. I mean, this is big. This would be big. And it'd be one thing if the Fed was the only central bank providing liquidity, but the Fed is not. It's the whole world has been through COVID. So I'm not a big believer that the dollar is going to be punished in such a way that we're going to see, the dollar sell off, unless we start losing our reserve status or something to that nature. Then that becomes a completely different ball game. But the one thing that I would err a little cautious here is, as we approach this really key support around the 120 level in the US dollar Canadian, you have to start thinking about central banks. And personally, I think that I know the Bank of Canada just started tapering, but I think when the Federal Reserve really starts the discussion of tapering, or tapering in general, you don't want to be short the dollar, I don't think. Steve, do you have any thoughts regarding what the dollar Canadian, and maybe what I'm talking about as far as the central banks go here?
To begin with, I'm more bullish than NOK. So I don't disagree with anything, but I've been long the NOK for a long time, and I chose it over Canada because I believe the Norwegian economy is better. So I think the USD NOK is an even better vehicle to be short. Now, having to do with if the dollar is going to react by going higher once there is taper talk, we'll have to see about that, having to do with timing, having to do with who starts it first. What are the intentions once something like that starts? What is going to be the speed of it? So I wouldn't want to speculate in advance about it. We can revisit once we get there, but my speculation is that we're still far away from that. I've explained multiple times the reasons why I believe the Fed is going to be extremely late in even considering attempting anything like that.
Well, when the dollar Canadian reversed up here, and if you guys don't recall, there's a story actually even posted on Bloomberg that said that they did not taper, but in essence, and what had actually happened is they did. So we saw this reversal on the dollar Canadian, false breakout above these highs after that false news story, and then we reversed. And everybody's like, wow, the dollar Canadian is so weak. And I in the chat room, I'm like, hey, don't forget, they actually did taper. They are the first central bank tapering these bond purchases right now. So that is something that we do have to take into consideration. Now we are at the 127% extension, but I still think that the dollar Canadian, this is going to be really, really critical support. And remember, a double top of this magnitude, I mean, it points a lot lower. I'd have to be pretty convinced that the dollar is, for me to be a believer that the dollar index is heading back to 70 or 80, I'm going to need some convincing after such a big move off of the highs. Because if we have, as you guys know, if we have any type of risk aversion, the dollar will catch a bid. And I don't know if you guys have seen it anytime in the near future or any time in the last year. We've actually rallied almost 100% off the COVID lows. When's the last time you've seen a market, Dale?
Yeah,
you've been here for you've been trading for more than 30 years. I'm not going to throw a number out at everybody. I've been trading for 25 years. When's the last time you have seen a market double, a stock market index double in a year?
never.
Yeah. I mean, it's unprecedented, the move that we're seeing. So can the market double again in the next year? I don't know.
Sure.
You know what I mean?
In nominal terms, it might.
What you mean? Because the dollar becomes so weak that it's doubling.
If the dollar keeps weakening and inflation starts accelerating even faster to the upside, I wouldn't find it completely impossible. Yes, it is very hard, right? Very hard. Not very hard for the other two assumptions, not very hard for the dollar to weaken further, or very hard for inflation to accelerate even faster, because I need to keep reiterating this because people don't seem to pay attention to important stuff. The rate of inflation we've had during the first quarter, annualized, points to more than 12% annual inflation, right? So if we continue in this path, we're talking about amazing numbers coming through now.
But it's transitory, Steve.
Yeah, of course it is. Of course, the Fed doesn't explain to us what happens if it isn't.
Right. That's a good point.
Yeah.
Hey, and you know what? That's probably, Steve. I hate to cut you off, but the great news is that if you are a Forex Analytics subscriber, even if you have the light version, which is $19 a month, you can listen into our advanced webinars where we're going to be doing the bias chart analysis here in about 45 minutes. Steve will be giving you his views on the markets, which you're right, Steve. Like the Fed doesn't tell us what happens if they're wrong, and it's not transitory, and lumber isn't where it's at, or copper isn't breaking higher, and prices aren't continuing.
And by the way, Blake, we know that one of two things is true, right? Either the Fed has no problem in lying when saying the truth is not convenient, or they're completely incompetent. How do we know this? Because they've never predicted a recession, ever. So equivalently, why would they predict sticky inflation,
Yeah.
right?
And oh, I'm sorry, go ahead.
My assumption, of course, is that they're lying. It's not that they're completely incompetent.
Yeah, right. And well, here's the thing, and this is a perfect segue to David Hunter, who's coming on. And Thomas said, "What about David Hunter's forecast that a top in the S&P will be 4,700 plus or minus, and then top
Might be.
either this quarter or next, and then down 80% in a deflationary bust." And you know what? I was actually just having a conversation with someone regarding Japan, 1980 Japan. And the always the pushback I get is, Blake, we are not Japan. You know,
Unfortunately, the
we're
US is not Japan. Yes.
It's a completely different, and I'm like, I know. I mean, I know the demographics. I know everything that had happened back in the 1980s, but I'm like, the charts and the charts are actually quite similar, scary wise, and
It's different this time, Blake.
it's always different. Yeah. Well, and that's going to be a perfect segue for you, Dale, because I'm interested to hear what Mr. Hunter has to say, and as our guest here on the FACE webinar. So, Steve, I'll see you in 45 minutes, and guys,
yes,
make sure
Bye-bye.
you tune in there.
Okay, David, I'm going to make you panelist, and then we'll get going. Welcome to FACE, David. It's a pleasure to meet you. If you could unmute. Not sure if you've been in Zoom before.
Yeah, I've been in Zoom. Can you see me?
Okay, who hasn't during the pandemic, right?
Yeah, exactly.
Okay, David, really, I want to thank you in advance for taking some time out of the trading day to be with us. And you're going to show your mug, so I guess I will do that too. Okay, so you're
Okay.
you're upside down.
Yeah, hold on a sec. This thing.
Okay.
Should...
Oh, I should have taken some Dramamine before this interview.
Yeah, there you go.
All right, David, really nice to meet you. So, you know, I understand that, you know, your reputation precedes you here. Some of your followers are here, and they've already laid out your scenario for the S&P to go to 4,700, and then the bubble finally pops sometime later this year, third, fourth quarter. But you know what I'm interested in is how people ended up in the industry. Like, for example, I started after college as a runner on the floor of the CME.
Oh, really?
And,
Yeah.
and then that was, you know, that led to, you know, getting to Series 3 and then going down on the floor and all of that, the long and winding road of, you know, I've been doing this, I think as long as you, from 1976. So
Yep, you're pretty close.
yeah. So, you know, we're not rookies anymore, and I'm just starting to get the hang of it.
Yeah, right. It takes a lot of time to make a lot of mistakes to learn from those mistakes, right?
Yeah. A veteran once told me when I first went there, and you know, they looked at me like a piece of meat when I was going to go on the floor, said, "Kid, this is a tough way to make an easy buck." And they were right. So how did it begin for you, Dave?
Yeah, I got out of college in 1973. And back then, of course, it was Vietnam time. And I went into school as I was a declared finance major as a freshman. And back then, as you probably remember, people were going to college to avoid the draft.
Yeah, student deferments.
So
right.
Most of the people at that time were, you know, what we used to call hearts and flowers majors, you know, liberal arts majors.
Yeah.
All they wanted to do was be in school, so they didn't go to Vietnam. And I knew, for whatever reason, that I wanted to be in finance right from the beginning. So I majored in finance through college, got an MBA, got a job in a bank in the investment department right out of school. Again, I knew I wanted to get into the investment business. I went to a small school out in the Midwest, Valparaiso, which you probably know out in the Midwest. And
Yes.
so it wasn't easy to get from there to Wall Street. So I took a job in the college town I was in in a bank in Indiana at that time. Branch banking was only county-wide, so we were the largest bank in the county. And it gave me the opportunity to manage both bank portfolio and trust portfolio, so equities and bonds. And I attribute that, I was there 5 years, I attribute that as to my macro skills today, as I got the taste of both sides, got to
Right.
work with bank liabilities, et cetera. So that gave me a lot of kind of the grounding. I got my MBA from DePaul by commuting from Valparaiso up to Chicago
Yeah.
a few days a week. It was a trimester system, so I finished in 2.5 years. I'd leave the bank at 4 o'clock, grab a Big Mac, and head down the Dan Ryan to DePaul,
Okay.
and then went from there to another bank in Connecticut. I grew up in Connecticut, so I went back east. I had to choose. It was a bigger bank, so I had to choose between stocks and bonds, trust or bank side, and I chose the stock side. And the rest was history. I basically from there managed pension money for Textron, was a senior VP, senior portfolio manager at Fidelity, running some big accounts out of London and Australia and Japan, running the US portions of global portfolios. Went from there, ran ITT Hartford's active equity department or portfolio, and then was a chief investment officer in New York for $1 billion firm. And then the other half of my career, really starting in the mid 90s or late 90s, was as a investment strategist, macro strategist, and I've been that ever since.
Okay.
And so it's been a nice, a lot of strategists, I think, come from the sell side. They don't have the money
Okay.
management experience, so that helped me a lot, I think, in having that macro grounding from an early age.
Okay, so I'm guessing that most of your analysis, at least in the beginning, coming from having a finance degree, was based upon fundamental analysis. And
Absolutely.
I'm wondering, when you came in and you were mainly using fundamentals, that sometimes the markets ignore the fundamentals for quite some time until they finally kick in. When did you or do you blend technical work with your fundamental analysis, and when did you, if you did, start using some type of technical measurements for to back up what you saw fundamentally? Because Jack Schwager once told me that he saw the most danger in the markets with fundamentalists, because the argument never goes away. The fundamentals could be right, but the market may not pay attention to them, and they don't have a place as a fundamentalist to say I'm wrong if it takes out this level or that level. So did you start applying technical analysis after a certain period of years, and who might have influenced you?
Yeah, absolutely. I would say, early on, I am kind of a lifelong contrarian, so that helped. I learned pretty early on that the market was part fundamentals, part technical, and part psychology. And so, I would say the psychology part was a big influencer. Early, I learned that pretty early on. Coming in 73, I saw the top of the Nifty 50 market, and then
Right.
what had been the biggest bear market until 2008-9 that we had seen in post-World War II era. So that was a real lesson in terms of, watching after your risks, understanding markets can go both ways. And you're right. I was fundamentalist probably primarily early on, but I would say in the first few years, I started paying a little attention to technicals, and certainly by 78, 79, I brought in technicals as part of my process.
Okay.
I'd say a guy like Bob Farrell was very
Okay.
influential early on,
Right.
and to this day, I look, because I really do combine fundamentals, technicals, macro, all of
Right.
it, and I'd say he's as close as anybody on the street in terms of knowing how to put it all together in a scenario. And so, definitely he was one of them.
Well, I marked the beginning of this bull market, August 1982. I was actually short IBM going into it. And really, this has been such a prolific bull market with bears being right occasionally with, we had 2000, we had 2008, and, many people scarred from what happened in 2000 and 2008. And I think that was what was behind self-directed trading. People said, hey, if I'm going to lose 60% of my money, it's not going to be with a salesman at a brokerage firm. I'm going to do it myself.
Yep.
And so, that was the beginning of, sting me once, sting me twice. I'm going to control my own money, of self-directed trading really taking off. So, your handle is interesting to me. And, with what your call is, you're still a contrarian, because there are a lot of people thinking that we are, in a peaking phase here. And your narrative is aggressive. Is 4,700 your target for this year?
Yeah, I usually put in a 4,700 plus, and I've been pretty vocal about the fact that I'm not going to be surprised if my numbers prove conservative. My targets typically are minimum targets. I would not be surprised if we see 5,000 this quarter.
Wow.
So I think we're approaching the parabolic melt up stage that takes us right to the top in a hurry. So I would not be surprised. It could spill into the third quarter, but I think we're getting pretty darn close to what I call the top of a 39-year secular bull market that started in August of 1982.
Yeah, right.
And I, you can make the case that the bull market really started in 74.
Right.
Down to 575 or where
it was in that 500 point range for how many years before it finally broke out?
Yeah, but I use 82 because 82 really marks the beginning of the disinflationary secular move from 15%, 20% inflation down to close to zero, and ultimately what I think will be deflation, and interest rates from 15% on the 10-year down to what we saw this year, 40 basis points. So I think that coincides because that was when you started PE multiples moving the other way, and so I use 82 as kind of the bottom of the secular bull market, and I think 2021 is going to be the top of that bull market.
Okay, interesting. And all being fueled by central planning, and is that the majority thesis on this?
Well, certainly not for 40 years or 39 years.
Yeah.
There's been real reasons for this move. It's been, it's been disinflation. You take inflation down from 20% to close to zero, and multiples go inverse to that. That's real. Earnings have had, they're starting certainly in the 80s, we began to really manage earnings, so there's a lot of stock buyback and financial engineering in it.
Yes.
You can call that whatever you want to call it, real or not, but it wasn't all central bank planning, but certainly, that's part of it. We've got asset inflation
the last 13 years.
Yeah, certainly. Well, and even all the way through, we've had, definitely. You look and you grew the balance sheet, from 875 billion to 7.5 trillion in the last 12, 13 years. That's a big part of this for sure.
All right, so let me ask you this, because you've seen a lot of seasons and cycles in the market, and a lot of people are making comparisons to the market to the dot-com era in 2000. I see the difference is that it was pretty isolated to the stock market, dot-com stocks. This time around, it's happening in real estate, it's happening in commodities, it's happening in equities, it's happening in crypto. It's hard not to find parabolic advances across different asset classes. Is that the beginning of a warning sign that we're in a blow-off stage now? This type of rampant speculation?
I think very much you're seeing, a lot of assets get blown up. You create trillions of dollars and they have to go somewhere, particularly, as I have said before, the cycle, the economic cycle starts, from a recession. You basically pump up the balance sheet of the Fed. You create money. That money has no economic need at that point because the economy's down. So that money has to go somewhere. It goes to the stock market as the residual, or the capital markets as the residual, both bonds and stocks.
Yeah.
As the economy recovers, some of that money starts coming out and going into the real economy where it's demanded. So we are getting close to that flip over stage where, it's not just a vacuum that money goes into the capital markets. So I think sometime within the next several months, money starts flowing from capital markets into the real economy. And that's the beginning of, I think, assets beginning to peak out and roll over.
Okay, so I know your view on the dollar, and the dollar is, could be the easiest sacrificial lamb to get out of this, right, David? I mean, if you're a bear in the dollar, you could still have nominal gains in a lot of things. It's almost invisible, except if you have to go out and buy anything, right?
Well, I'm not in the camp that a weak dollar is going to bail us out. I think it may certainly play a role in this blow off.
Yeah.
So for a month or two or three, it could. Yeah. I think we're going to see the dollar down to 85, the dollar index down to 85, and probably down to 82 before Labor Day. So I think we're going to see this down sharply. So in that period, it can certainly, that's why I don't pretend to think 4,700 is a point in time correct call. We could see this thing do some crazy things, meaning the stock market in a very short time. So you could see it go from here to 5,000 or even higher if you get the combination of a very weak dollar and more fiscal stimulus and the Fed continuing to provide money. So I think we're in that stage. I've used the term. Let me just finish this. I've used the term parabolic melt up throughout the last year for what I think this last stage is. And we've really been in a parabolic. You step back, depending on how long your chart is, you'll see we've gone vertical. But as you get closer, it doesn't look so vertical in the shorter charts.
Right.
People are going to be surprised at what a true parabolic looks like. I mean, it's just going to be straight up. And so you can cover a lot of ground in just a matter of weeks.
Okay, so
I'm sorry, Dale. Hey, good morning, Dave. This is Blake Morrow. How are you?
Good. How are you, Blake?
Great. Hey, thanks for joining us today. And I just wanted to say we were having this conversation before you had joined us, and we were talking about, I haven't seen, and it's been years, obviously, except for what just happened in crude oil this last year, where we had this capitulation for the obvious reasons. But I don't think most people that have been around less than 20 years have seen what a parabolic complete melt up or just kind of a pure liquidation move. I don't think many people have seen that. Would you agree?
Yeah, I would agree. Yeah, people throw around the term melt up a lot, and I go, there really aren't a lot of melt ups. What we're talking about is an equity melt up. Real estate's had a big rally here in the last several months. Bonds have had a long run, but a true melt up, well, I would say maybe what we saw in bonds last March was some sort of a melt up, but melt ups are very rare. And yes, you can look at the 2000 NASDAQ run as some sort of a melt up, but this is a broad-based equity market melt up. I don't really think we've had one since 1929. I mean, this is going to be a rare thing.
Okay, David.
Yeah, I agree, and I just wanted to just comment. Thank you so much for being here and echoing those same comments that I was having just before you got here too. I think it's a really rare occurrence, but thank you.
You're welcome.
Okay, so David, what ends it? Higher yields?
Well, higher yields, I think more importantly, I think it's probably going to be a shrinking of the balance sheet. I think, you saw in Paul's conference call yesterday, he's starting to have people hold his feet to the fire or try to hold his feet to fire about when are you going to have to deal with this inflation. And he did his best soft shoe to say, not now. He's very transparent that we're not ready yet, because he knows the minute he speaks it, it's going to be trouble for the markets and make it harder for them to manage the economy. So
what pushes him? What pushes him to start reducing the balance sheet?
When inflation within the next several months, I think, but probably sometime this summer, is going to start ramping up towards over 3%, towards 4%, I think, at least, counting in the commodity side. And I think it's going to get very uncomfortable. And at the same time, if numbers come out where we have 8% plus GDP growth in first, second, third quarters, somewhere in there, it's an overheating in the economy that we're beginning to already feel, and a run up in prices that he can't ignore. So I think that we're not that far off time wise, but he's being very sincere, in my opinion, in terms of saying we're not there yet, we're not even close yet. In his mind, they're not going to have to tighten this year. In my mind, they're going to have to tighten by Labor Day.
Well, I mean, let's even talk about his relevance. 10-year yields went from 50 bips to 170 without the Fed. So right. I mean, remember the guys they used to call bomb vigilantes?
Right.
Okay, so they've been buried for 30 years. I think there's some resurrection happening with them, and the Fed doesn't have to tighten for yields, especially on the back end, to reflect the inflation fears. Isn't that correct?
Yeah, that's exactly correct. I've said many times, interest rates are not controlled by the Fed; they're controlled by the market. So,
right.
So I have a forecast out there of 2.5 on the 10-year and 3% on the 30-year this year.
Okay.
And I think that's where I think rates will go. I actually think we're headed for 120 on the 10-year first, in spite of this backup of 10 basis points the last week. So I think we're heading for 120, and then you begin the inflation concerns and that. And what I remind people is the Fed, when people say, well, the Fed's not going to pull any money out, I go, don't forget, last July, they pulled $300 billion off the balance sheet. We were barely a couple months removed from the second quarter swoon, and they were willing to shrink the balance sheet because they didn't want to go too far. So I think you could see, if this thing gets overheated like I think it's going to, I think you could see as much as $1 trillion pulled off the balance sheet. And if they do that just puts pressure on rates, that puts pressure, it takes money out of the capital markets. I think that could be enough to really tip things over. And then once you get going south, I think people are going to be surprised at the speed with which this thing can unwind.
Will they do that, David, through match sales, so that market participants know that they're draining reserves when they do match sales instead of reverse repos?
It's probably going to be a combination, but I certainly think they'll do some match sales. Yes.
Yeah, and I have Brian Picard asking, how does the Fed pull $1 trillion off the balance sheet? How do they do that?
Yeah, it's repos. It's it's all that. It's basically they're going to be selling bonds back to the dealer banks and bringing the money out of the system. So it's go back to last July. Some of it will happen quietly. They're not going to announce it, I don't think, but Fed watchers will see it happening with some lag. And I think you could see that before Labor Day.
Okay, so that's interesting. We're going to have quite a fall to be, and just sell in May and go away again is not going to be a good philosophy, especially with what you're talking about. People
I think May and June may be upward fireworks, and that sometime this summer we begin the other side. Now when I talk about, and again, I realize I could be off by months, But
Yeah.
I think the potential is there for a top in the stock market this quarter. And then people say, oh, you're changing your mind because now you're talking about a bear market starting in third quarter. I go, you don't hit a top and go straight down. Tops
You have
can
to-
take several months. So,
Yeah.
you could have both happen. You could have a top made this quarter, but really not start really rolling over until, 3 months later, 2 months
Yeah,
later.
you would need
So-
some distribution, right? I mean, it takes time to turn around a battleship that's been
Yep.
going in one direction for 30 years.
And it's also a case where it happens in many different shapes and sizes, but most tops, you might have a step down of, 8 or 10% and then rally back and retest the highs or get, 3/4 of the way back to the high. So it's not we make a top tick and then you're down, 80%. It's gonna, I think it's gonna be, there's gonna be people on both sides of the equation trying to guess, is this a top or isn't it? Is this just a pullback? So, I think people think too linearly. They kind of expect everything to be bing, bang, boom, exactly as you see it,
Okay, so I'm wondering, where are people going to hide? And it'd probably be different asset classes at different times. Do you think the gold? I looked at some of your targets and what you think about, and some of your targets and levels you're looking for in currencies and gold and GDX. Does this participate with the melt up like it is now? And will those assets, inflationary assets, be vulnerable when the market peaks? It's like everything's gone up together, David. Is everything going to be liquidating out and declining together in your deflationary bust, except maybe cash?
Yeah, well, actually, no. The majority of assets are going to go down together. Yes, I think real estate will be hit. Junk bonds, corporate bonds will be hit.
Yeah.
The two things I think will go up in the bust will be the U.S. dollar. Once we get down to 82, I'm saying you could see a run to 120 or even 140, because
Wow.
I think
Yeah.
this will be a global bust. And
Yeah.
as hard as we're going to be hit, I think Canada and Europe are going to be hit harder, and maybe Australia. So, and maybe parts of Asia. So, so there's going to be, again, as typically happens, I still think the dollar is going to be the place where people run for safety, relative safety. We're going to be hit hard, but I think people say at least the U.S. we know is going to survive this. So I think
DJ said he will. DJ said he'll hide in the Caribbean with a well-stocked bar. So let me ask you this, Dave, and there's
Let
a
me
lot
finish
of
one last thing.
Yeah, go ahead.
So that I don't leave it out. And the other asset that I think will do very well
Gold.
in the bust is U.S. Treasuries. So
Okay.
I expect the 10-year to go to zero. I expect the 30-year to probably go to a quarter or something close to that in the bust, because it's a deflationary bust. It'll be fast, but it'll tip us into negative inflation, I think. So we'll go from this inflation scare this year to actually negative inflation sometime in the next year.
Okay. And looking at all of this happening here, with what's happening in our country, and people are asking me to ask Dave the question from Q&A. I believe I am doing that. What's it going to be like? And with people already suffering and things are good for a lot of people that own financial assets, and that big 2 billion or whatever loss by Bill Hwang or whoever was running that hedge fund that was in a bull market. Can you
Yeah.
imagine what happens when the tide goes back out if you could have those kind of losses in a good market, in a powerful good market?
Yeah, for sure. That's the tip of the iceberg. Just like we saw in 2007 when Bear Stearns had those two leveraged funds run into trouble. It was still another year before we really found out what that was the precursor of. So
Right.
Same thing here. I think that was, tip of the iceberg. And we will see much more. Keep in mind, we've got pension funds,
Yeah.
you know, and we've got people leveraged up to the hilt in so many places. So the bubble's blowing up, you know, is being blown up, meaning getting bigger. And when it pops, you know, there's going to be a lot of pain. So
Do you think we're going to have a lot of social unrest after the bubble pops? What are you doing to prepare for it besides financial markets and positioning yourself there? Are you a prepper?
Let me make clear, because I want to separate myself out from
Jim Rickards?
the Peter Schiffs and Jim Rickards
okay.
of the world. This
Okay.
is not the end cycle. This is not the, you know, we're down for the count. There is a recovery cycle after this that is big. As I say, this secular top in the equity market, but if you go down 80%, you can still come back from, let's say, 1,000 on the S&P. You can triple and still be far below the, you know, the higher mark, or even quadruple and be below the high water mark of this cycle. So,
right.
So there will be a cyclical bull market, just not a secular bull market after this. I am calling for a big, and this bust will be pretty much contained. Why I call it a bust, not a depression, because I think it'll be pretty much contained within a year, within 12 months time. So, you know, you'll have the market down, let's say potentially 80%, and the economy down the biggest post-World War II we've had, but all contained within pretty much a year. So
okay, compressed depression.
On the other side of that,
Yeah.
we will have the first big industrial-driven, inflation-driven global recovery we've had since 1970s. So it will not be a consumer-driven cycle. It will be very much something you and I are familiar with, but most people are not. And why will it be industrial? It'll be industrial because there'll be massive fiscal programs coming out of governments across the world. You know,
Okay.
in China, it'll be Belt and Road. In the US, it'll be all the infrastructure spending, et cetera. And it will lead to a commodity cycle unlike any we've had in the history of the world. I mean, I expect oil to go to 300 plus, and this is all this decade.
Where does it go in the butt? Where does it go in the butts, David, before it goes to 300? You think
I'm calling for oil. I'm calling for oil up to 75 this summer, and then down to $10 again in the bust.
Wow.
And then from 10, it begins to climb to 300 plus. And you know, natural gas will go through the roof. You know, copper will go through the roof. All the metals, you know, gold will go to 10,000, silver 300, and again, those are minimum targets. I think we go a lot higher than that probably.
Okay, so this is just a prelude of what's happening in soybeans and the grains. I mean, if you look at what the grains have done, and you know, I talk about grains, Dave, and you know, Fed could raise rates and reduce their balance sheet, but they can't print corn, and they can't print wheat and beans. So isn't it possible that even though we have a deflationary bust, that we could still have high prices for necessities like food during that time?
Yeah, I think for sure, since it's only going to be, if I'm right, that it's only be, you know, a year long, it's not enough time to really have it go 100% the other way. So I think certainly, I think the grains are hard to call in terms of the short term. The longer term is that this is the beginning of a huge run up in commodity prices of all kinds, including the grains and the livestock. So I believe, you know, that the Farm Belt will be the real estate sector of the next cycle. You know, the coasts are going to suffer the hangover effects of this bust, and interest rates. If inflation's going, and I should say this, I expect inflation in between now and between the deflation of the next year and the end of the decade, I expect a full retracement of the last 40 years of inflation and interest rates. That means we go back to 20% inflation, we go back to 15% long bond, we go back to 20% T-bills, all before the end of the decade. So,
wow. Yeah.
And that's because of all this money. And by the way, in the bust, I think you're going to see Fed balance sheet grow to 20 trillion plus. So with all that money, and again, the same thing all around the world, with all that money, you're going to jumpstart an inflation cycle like we've never seen.
I'll tell you what, David, what a great time to be alive. What the trading opportunities are massive with your narrative. And I'm so glad I reached out to you on Twitter. I've enjoyed talking to you, and I learned from you today, and thank you for edifying our community with your macro views, David.
Yeah, thanks, Dale. Yeah, I sound like a crazy man with some of this talk and the volatility that I'm describing, but I think we're coming to the end of a super cycle, which I define as the points between two depressions, the 1930s being the last one, the 2030s being the next one. And this bust is the precursor of that, but it's not the depression.
Okay, so good news along with some massive swings in many different asset classes. You know what happens, David, when you survive an interview with me?
No.
You become my trading warrior brother for life.
Hey.
You can't get, it's like the mafia. You can't get out. You can't leave. You're my trading warrior brother for life. And I've really enjoyed talking to you, and hope that we could do this again.
Yeah, thanks, Dale. I really appreciated you having me on.
All right. Well, everyone, and you have no axe to grind. Do you want people to at least follow you? I mean, you could follow Dave on Twitter. You don't have a business model for this. You're a strategist for.
Yeah, actually, what I do have is I do have an investment letter, a macro letter that I put out quarterly, and it's by subscription. So I do make money off of that. If people are interested in it, just direct message me on Twitter. And my Twitter handle is @DaveH_Contrarian.
What's the H stand for? Is that your middle initial? H?
No, H Hunter. H stands for Hunter.
Oh, okay. Dave H. All right. Contrarian. It really was eye-opening to hear these narratives and the kind of swings we're going to have, and fortunes will be made and lost. And what the Chinese say about a crisis, it's danger and opportunity. And the danger is you miss the opportunity. And I think you've opened our eyes to the massive opportunities that lie ahead. Thank you so much, David.
Yeah, that's better than better than your former mayor said, where we never let a crisis go to waste.
Yeah. All right. So everyone, don't just count your deflationary busts or inflation runaway, count your blessings. And remember that pips come and go. Time is gone forever. Make it count. And as we are living in interesting times. So again, David Hunter, thank you for joining us on Face. It was enlightening for everyone that heard you today.
Okay, thanks, Dale. Thanks for all the good questions.
All right. That's a wrap, everyone, for Thursday. We'll see everyone for TGIF. And you could join the team for the Morning Edge in 7 minutes. Adios, everyone. And thanks again, David Hunter.